So the next type of risk we'll discuss is compliance risk. Compliance risk relates to risks from a company, institution, or coin project regarding law and regulation compliance. So if a trader chooses to use an exchange with questionable practices, let's say that exchange doesn't use anti-money laundering or KYC, know your customer policies or procedures, the exchange may be subject to disciplinary action from regional governments. If the exchange shuts down, you may not be able to retrieve your funds or investments. So let's say you are a citizen of the United States and you found this far off cryptocurrency exchange that's based out in Asia, somewhere in Southeast Asia, and you're using it. You have access to all these coins that you can't buy living in the United States, and they don't ask for any identification. There's no KYC background checks or anything like that. Now, if regional governments in Southeast Asia were to turn against those exchanges and demand that they shut down, there's a chance that you might just lose your funds in that, and there's really no way of recovering them. This is something that has happened in the past. We don't see it happening as much in 2021 and 2022 compared to when crypto was really first starting off back in 2012, 2013, 2014. But there's still the risk, and it's something that we all need to be aware of. Now, if a trader chooses to invest in a coin project with questionable practices, the project may be subject to investigation, which could affect its price valuation. And we most recently and most famously saw this occur with XRP Ripple. So XRP is a popular cryptocurrency. It's usually about sixth in market cap. It's typically in the top 5 or top 10. That varies from week to week. And it specializes in facilitating trustless, instant, and cheap cross-border payments. Ripple is the for-profit company that controls the development and marketing of RippleNet, which is the digital payment network that runs on the XRP ledger. XRP is the native token on that network, on the RippleNet. Ripple is the company that controls the development and the marketing of RippleNet and XRP. Now, on December 23rd, 2020, the SEC filed a lawsuit against Ripple Labs Incorporated, claiming that it had raised over $1.3 billion through the sale and distribution of XRP without registering as a security. As a result, the price of XRP fell over 25%, and some US-based exchanges halted trading of the coin. This was widely seen in Coinbase and other exchanges. Gemini, they all were quick to comply with their regional mandates from the United States government. I mean, it wasn't necessarily a mandate against the exchanges to delist Ripple, but to save their own skin, they're going to quickly delist it because they don't want to be accused of selling illegal securities. And here is the press release. This was from the U.S. Securities and Exchange Commission website, dated December 22nd, 2020. Essentially, it was just a claim that these were unregistered securities, that when you're buying XRP, you're essentially buying some sort of incentive into the Ripple company. Now, without getting too much into the details of the lawsuit, as a result, we did see a significant drop in the price of XRP. Here we were beginning to see a continuing rally in the overall cryptocurrency market. XRP reaching recent highs of about almost 80 cents per, from lows of about 25. So significant price increases over a month period or so, from early November into late November, really within a month, and then going into December. Here we saw this was the beginning of that lawsuit claim and the investigation, and here is the significant price drop from just about 45 cents to a low of about 20 cents. So this equated to just about 61.31% decrease, a percentage loss in valuation per XRP. Essentially, there was a mad scramble, a huge sell-off across the world. Particularly, we even saw it in the US because the exchanges were delisting it. People didn't want to hold on to a coin that wouldn't be listed any longer, so it made sense at the time to sell. Now, the debate is, was it a currency or was it a security, or is it a currency or a security? It's still, this at the time of recording, this still not has been resolved. So as a result of the lawsuit, XRP's price fell from about 45 cents to 17 cents in 6 days, a 61% drop. Many investors had opted to sell their holdings as it was assumed to be too high of risk to hold a coin, even if they did not believe that the SEC case was legitimate. Some investors, on the other hand, they saw the plummeting XRP price as a buying opportunity. Whether they acknowledged it or not, a significant amount of risk was taken on by investors who bought these market lows. They bought the dip, so to speak, in an effort to capitalize on the case being dismissed. People were buying at these low prices saying, oh, it's going to be dismissed, and when it does, it's going to skyrocket. Now, here we see from the extreme lows in late December of about 17 cents or so, we did see over the next few months, XRP's price did recover. Even though the case was not yet dismissed, XRP's price did recover. And in about 106 days from that late December day, the late December low, up into about April 14th, give or take, we saw XRP increase over 1,000%, 1,033% in 106 days. So that was a significant price increase, but there was also significant risk taken on. So this was a high risk, high reward play. The next types of risk we'll talk about is systemic versus systematic risk. So systemic risk refers to the chance of an event or an action triggering a detrimental effect in a specific market or industry. Systemic risks are typically shared by strongly correlated markets and companies. An example of a systemic risk could include the banning of Bitcoin and cryptocurrency mining in China, which had a rippling effect in the industry-wide market. There was a significant cryptocurrency market crash, and we could attribute that crash to the banning of Bitcoin mining and crypto in China. There were other reasons why, but if we wanted to single out one specific reason, we could use cryptocurrency mining, the banning of it, and the complete outlawing of crypto in China. Now, while systemic risks are particularly sector or specifically industry-based, systematic risks found next, this differs in that systematic refers to a wider range of risks beyond a single industry or market. So here it's not just about crypto, it's not just about tech, it's not just about renewable energies or commodities. This could include factors such as inflation, interest rates, war, natural disasters, pandemics, major governmental policy changes, general crises. This can all have major impact on not just one sector or not just one financial market, but all global markets. Now, managing different types of risk. In terms of market risk, if you're worried that the market will move against your position, it would be wise to set up a stop loss order on every trade so that your trade will close before it suffers larger losses or before you are just stuck in that specific position before the market has time to recover. We'll go over stop losses in one of the upcoming lessons. In terms of liquidity risk, if you're worried that there isn't enough liquidity for your trades, only trade Bitcoin or Ethereum, large market cap coins, as they have much more trading volume compared to other coins. You might also want to choose only high volume exchanges such as Coinbase or Binance. Now, this in particularly, this is really applicable to traders with large accounts, large trading accounts, because if you're trading, let's say you're trading $500,000, you might have a harder time filling your orders for trades because there might not be enough people who want to sell at the price that you want to buy into. And let's say once you're in the position, there might not be enough people who want to buy when it's time for you to sell your position. Remember, you have to trade to another person. You're not just directly trading to the exchange. So that's something that is particularly focused on traders with larger trading accounts. If you're trading with, let's say, like $5,000-$10,000 or so, or maybe even 50, you might not necessarily have as much of an issue trading and filling positions and unloading positions or selling positions over time. But that will also, once again, vary based on the exchange you're using. If you're using a low volume exchange and you're trading some really out there trading pair like that Smartlands example that was shown below, there might not be enough people that actually want to buy your position when it comes time for you to want to sell. In terms of compliance or operational risk, if you're worried about the coin project that you want to invest in, and if you're worried that it could be breaking a law or be a scam, research the company, read the white paper, look for an update schedule. Particularly for this, I highly suggest you check out our section on fundamental analysis. And this is really where we talk about not just the fundamentals of the coin metrics itself and what kind of project it does, but really how to research the team behind the project, research what the project attempts to do, the white paper, and this will help guide you and differentiate between possible scams and legitimate projects. Another thing to consider is diversifying your portfolio. This will act as a buffer in case one of the invested projects fail. Now, in terms of systematic or systemic risk, if you're concerned that a specific market could crash, once again, you should consider diversifying your portfolio into different areas to not overextend your funds in one specific field. This could entail diversifying into projects with different use cases or even different industries or markets. The goal is to not have a high correlation between held assets in case that one falls, the rest will not be pulled down alongside with it. So this could be not just going all in on crypto, because if crypto market were to crash, all of your investments are going to go down with it, right? Everything follows Bitcoin. And the same thing realistically with technology as well. If the tech sector and correlation with the stock market if the tech were to go down, Bitcoin most likely is going to go down too, because there is a high correlation between Bitcoin markets, cryptocurrency markets, and the technology markets on the traditional equity markets and the stock exchange. For more information between correlations between crypto and traditional markets, be sure to check out our section on those correlations. We'll have a separate lesson just for that.